Gas prices may be heading back toward $4 a gallon, but the IRS has just increased a valuable tax deduction for certain drivers. Beginning July 1, 2026, the business mileage rate rises to 76 cents per mile. But before you start saving every gas receipt, there is something important you need to know. This is not a tax break for everyone who drives. It does not cover your ordinary commute, and it does not mean that the government will reimburse you 76 cents every time your odometer moves. So, who qualifies? How much could the deduction really save you? And what records must you keep so the IRS does not reject it? Let us break it down. This is the wealth pier, where wealth means more than money. It means protecting your health, independence, security, and peace of mind after 50. The IRS originally established a business mileage rate of 72.5 cents per mile for 2026. Because of increases in fuel prices, the agency made an unusual mid-year adjustment. For qualifying business miles driven from January 1 through June 30, 2026, the rate remains 72.5 cents per mile. For qualifying miles driven from July 1 through December 31, 2026, the rate increases to 76 cents per mile. That means you will need to separate your mileage into two periods when preparing your 2026 tax return. The mileage rate does not represent gasoline alone. It is designed to account for several costs involved in operating a vehicle, including fuel, maintenance, repairs, insurance, depreciation, registration, and general wear and tear. You therefore cannot normally use the standard mileage rate and then deduct all your gasoline, repairs, depreciation, and insurance again for the same vehicle. That would amount to deducting the same expenses twice. The deduction primarily benefits people who use their vehicles while operating a business. That can include self-employed consultants, independent insurance or real estate agents, Uber and Lyft drivers, DoorDash, Instacart, and other delivery drivers, home repair professionals, caregivers operating an independent business, freelancers visiting clients, small business owners traveling between business locations, and retirees who have started a part-time business or consulting practice. The important factor is not your age, your job title, or whether the business is full-time. The important factor is whether the driving has a legitimate business purpose and whether you are entitled to deduct business expenses. Most self-employed taxpayers report these expenses on Schedule C. The biggest source of confusion is commuting. Driving from your home to your regular workplace is generally considered personal commuting, even when you drive a long distance. That mileage normally does not become deductible simply because gasoline is expensive. For example, suppose you work as an employee at an office 20 miles from your home. Your morning drive to that office and your evening drive home are generally personal commuting miles. Most W-2 employees also cannot deduct unreimbursed vehicle expenses on their federal income tax returns under current federal rules. However, different rules may apply to certain narrowly defined groups, and some states may allow deductions that are not available on the federal return. This is why employees should ask their employers about a mileage reimbursement program rather than assuming they can claim the mileage personally. Here is a simple example. Maria operates a small bookkeeping business from a qualifying home office. She drives from her home office to a client's business, then to an office supply store, and finally back to her home office. Those trips may qualify as business mileage because she is traveling between business locations. Now consider Robert. Robert drives from home to the same employer's office every morning. That is generally commuting and is not deductible. If Robert leaves his regular office to attend a temporary business meeting at another location, however, that additional business travel may qualify for reimbursement by his employer. The exact treatment can depend on the location of the taxpayer's principal place of business and whether the home office satisfies IRS requirements. Do not automatically classify every trip beginning at home as business mileage. Menzin. Suppose you drive 10,000 legitimate business miles during the second half of 2026 at 76 cents per mile. Your vehicle deduction would be $7,600. But that does not mean the IRS sends you a $7,600 check. A deduction reduces the amount of income subject to tax. Suppose that deduction ultimately offsets income taxed at an effective combined rate of approximately 25%. A $7,600 deduction might then produce approximately $1,900 in tax savings. The actual result depends on your income, filing status, other deductions, self-employment taxes, and state taxes. Here is another example. Suppose you drive 5,000 qualifying miles during the first 6 months of 2026 and 5,000 during the second 6 months. Your first half calculation would be 5,000 miles multiplied by 72.5 cents, or $3,625. Your second half calculation would be 5,000 miles multiplied by 76 cents, or $3,800. Your combined standard mileage deduction would be $7,425. That calculation demonstrates why separating the two periods matters. Using one rate for the entire year could produce an incorrect return. Eligible taxpayers generally have two possible methods. The first is the standard mileage method. You multiply qualifying business miles by the applicable IRS rate. This is usually the simpler approach. The second is the actual expense method. Under that method, you track expenses such as gasoline, oil, repairs, tires, insurance, registration, lease payments, and depreciation. You then deduct the portion attributable to business use. The IRS confirms that taxpayers may generally deduct actual vehicle expenses or, when eligible, use the standard mileage rate instead. For example, imagine that 60% of your vehicle use is for business. Under the actual expense method, approximately 60% of qualifying vehicle expenses may be allocated to the business, subject to the applicable tax rules. Which method is better? A high-mileage driver using an inexpensive, fuel-efficient vehicle may receive a larger deduction from the standard mileage method. Someone with lower mileage but unusually high vehicle expenses may benefit from the actual expense method. But there are restrictions. Your method choice during the first year a vehicle is placed into business use can affect whether you may switch methods later. Accelerated depreciation, Section 179 deductions, and certain lease arrangements can also change your options. That is one area where professional tax guidance may be valuable. You cannot safely claim business mileage based only on an estimate. You should keep a mileage log showing the date of each trip, the starting location, the destination, the business purpose, and the number of miles driven. You should also record your vehicle's total mileage at the beginning and end of the year. That helps establish what percentage of the vehicle's overall use was business-related. A paper mileage book can work. A spreadsheet can work. A mileage tracking application can also work. The best system is the one you will actually maintain consistently. Do not wait until tax season and attempt to reconstruct an entire year from memory. Calendar entries, customer invoices, appointment records, and repair receipts may support your log, but they are not always a substitute for a proper contemporaneous mileage record. First, begin tracking immediately. Even if you missed the first half of the year, start maintaining an accurate log now. Second, separate personal, commuting, business, medical, and charitable mileage. They are not all treated the same. Third, label the two halves of 2026 separately. Use 72.5 cents through June 30 and 76 cents beginning July 1. Fourth, calculate both the standard mileage and actual expense methods when you are eligible to choose between them. The easiest method is not always the method producing the largest deduction. Fifth, preserve your supporting records. Keep mileage logs, receipts, appointment records, and business documentation with your tax files, non-called biggins. There is also a separate mileage rate for qualifying medical transportation. Beginning July 1st, 2026, that rate increases to 23.5 cents per mile. Medical mileage is different from business mileage. It may include transportation, primarily for, and essential to, qualifying medical care. However, medical expenses are generally claimed as an itemized deduction and are subject to an adjusted gross income threshold. That means recording medical mileage does not guarantee that it will reduce your taxes. Still, people facing frequent medical appointments should maintain a log because the mileage may become valuable when combined with other qualifying medical expenses. Mileage driven while providing services to a qualified charitable organization remains at 14 cents per mile. Unlike the business and medical rates, the charitable rate is established by law and did not increase with fuel prices. This may apply when you use your vehicle while volunteering for a qualifying organization. It generally does not apply merely because you drove somewhere and made a donation. The transportation must be connected to providing charitable services. Manfare Viakum Sund. You may also see online posts promising a special fuel tax credit for drivers. Be cautious. The federal fuel tax credit generally applies to specific non-taxable uses of fuel, such as fuel used in farming, commercial fishing, certain buses, or off-highway business equipment. It is not a general credit for gasoline used in your personal car or for ordinary commuting. Improper fuel tax credit claims have been associated with misleading tax promotions. Do not claim it simply because you purchased gasoline for a vehicle. The new 76-cent mileage rate can produce a meaningful deduction, but only for taxpayers with qualifying mileage and adequate records. Remember these 3 points. The higher rate begins on July 1, 2026. Ordinary commuting does not qualify, and the deduction is only as strong as the mileage records supporting it. A few minutes spent recording each business trip could protect hundreds or even thousands of dollars in legitimate deductions. Before claiming a major vehicle deduction, speak with a qualified tax professional who can review your business structure, vehicle use, prior depreciation, and state tax rules. This video provides general educational information and is not individualized tax, legal, or financial advice. If this information helped you, subscribe to The Wealth Peer, because real wealth after 50 is not only about earning more, it is about keeping more of what you have worked for and avoiding costly mistakes.